So I finally decided to buy a brand new speculative growth stock called 2U, ticker symbol TWOU. If you've seen my previous videos, you know that I've had my eye on it. Well, today it crashed by 25% in a single day, got absolutely destroyed, and I just couldn't help myself. I took the opportunity and I started buying into the stock. So I really want to talk to you guys about it. It's an online education company. So it's like a software and services company. We'll talk about that in the video, and should be a fun video. But with that said, let's go ahead and get started. What's up, everybody? My name is Ale and welcome to my world of stocks. Now, I fully consider 2U, this company, to be a spec stock because they're losing money, a relatively new company, but they have high sales growth. And so for me personally, when I think of a spec stock, I usually think of for me to invest in a spec stock usually has to be like a market disruptor. So something like Amazon, Tesla, Netflix. Amazon I don't really consider a spec stock anymore because they're becoming more and more profitable, but usually a relatively new company that is losing money but has high sales growth, and it's usually a market disruptor. And for me, when looking at 2U, it's an online education company. That's where I see them disrupting the market, because I think that higher education is really headed towards an online future. It may not go like fully online, but in the kind of short, medium, and long term, I see it becoming more and more online. And so 2U would be kind of a direct play on that. And so that's why I'm excited about this company. So we're going to talk about all of that in the video, but let's go ahead and start. We'll take a look at why it crashed and why I'm investing in it. But let's start by looking at the company fundamentally and looking at what they do and what their business is about. Now, when looking at their company and the business, they were founded in 2008 and barely went public in 2014. So this is really a very young company. And again, when looking at their business, they offer an online education platform to their customers. So colleges basically hire 2U to provide them with software solutions that help them teach their programs online. That, of course, is very appealing to schools because it means that they can provide greater accessibility to students while potentially lowering costs over the long term. Their operating system, dubbed 2UOS, even offers cybersecurity and machine learning capabilities, along with a team of counselors and IT solutions experts to offer a wide variety of services to each of their partners. So this is really a software and services type of company in the higher education industry. Speaking of which, 2U has already attracted as many as 36 universities and have so far announced 68 graduate programs, along with many other short, non-degree or skill-based courses as well. Over 100 of those, I believe, so far. And these aren't just little or relatively unknown schools, as the list includes very notable names like American University, Baylor, Georgetown, Harvard, NYU, Pepperdine, Syracuse, Berkeley, Davis, UCLA, Yale, University of North Carolina, and USC. And they're even expanding internationally now with new programs in London and Monterey, but more on that later. By the way, 10% of the revenue comes from North Carolina, while 27% comes from USC, meaning that a large portion of their sales actually come from well-established institutions. But the crazy thing is that used to equal around 75% of their sales when they IPO'd, so it really shows how incredibly hard they've worked at diversifying their business to not be so reliant on just a handful of schools. And we'll talk more about that, their growth, and their future potential in just a second, but first I want to mention why the stock crashed. Now, despite the recent sell-off, they are actually up still by close to 300% in the past 5 years, so any early long-term investors don't really have much to complain about. But if we look at more recent history, I was talking about this stock in 2018 when it was trading at some of its highest levels, and what I said then was, look, this company is really interesting to me because I think online education is really the future, but I just can't jump into it yet because it's trading at a really high valuation. And we'll look at that more a little later, but what ended up happening is that the stock came crashing down after, and I got super close to buying it. But because the overall market was crashing at the same time, I just saw too many stocks out there that were more appealing. So I funneled my money into stocks like Disney, Microsoft, Amazon, AT&T, Alibaba, and so on. But so far in 2019, the stock just took off like a rocket ship, and I've been kicking myself ever since for not having opened at least a very small position. Yet here we are right after their Q1 earnings, and the stock has presented me with a gift, crashing down once again, this time by over 25% in a single day, wiping clean all the huge gains it made earlier in the year. So given that it's now down about 55% from their 52-week high, I am finally feeling comfortable with starting a small position and adding to it over time if it continues to drop to create what will be a very long-term speculative investment. Now, let's look at the reasons why it crashed in the first place. And in my opinion, this was all pretty overblown, but I suppose it makes sense given how much the stock had already climbed previously. In any case, they announced sales of $122.2 million for an increase of over 32% year over year, which is actually fantastic growth, and it's even higher than what they were guiding for, which was $121.5 to $122.1 million. On the other hand, their adjusted net loss came in at $8.6 million, which is higher than the $6.1 million that they reported the year prior, and this was mostly due to increased investments and higher marketing spending, but it was still lower than their guidance of negative 18 to 19 cents per share, coming in at just 15 cents per share negative, obviously. So overall, it was actually a pretty solid quarter that beat both their own guidance and analyst expectations. Yes, losses came in higher than last year, but they were still lower than expected, and sales grew by over 32%. So that's not really worthy, in my opinion, of a 25% drop in stock price. The problem, however, came in the form of guidance. As we often see, companies can report strong numbers, but if guidance is off, then Wall Street will absolutely punish the stock and tank it, especially if it's a high growth, relatively new company. Now, sales guidance for the second quarter came in at around $124 to $125 million, but Wall Street was looking for $128 million, so they came in about $3 million lower for the next quarter. They also guided adjusted EPS at negative 35 to 36 cents, but Wall Street wanted to see negative 34 cents, so about 1 cent off of that as well. But the real issues, I think, were for the full year, as they guided sales to come in at $534 to $537 million, which is down from their previous guidance of $546 to $550 million. That's pretty significant, at around $10 million lower than what they were previously guiding. Still, there was at least some good news, as they also guided for adjusted EPS to be negative 31 to 34 cents, which is actually better than their previous estimate of negative 33 to 37 cents per share. So even though this next quarter is going to be rough and sales for the full year will be a little less than expected, their march to profitability should improve dramatically in the third and fourth quarters. And as far as the reasons for lowered guidance goes, that mostly has to do with expected enrollments in their top graduate programs being weaker this year than previously expected. In fact, their top 5 graduate programs, which they refer to as DGPs, are expected to see enrollment declines of 20% in the year compared to 2017 numbers, based on data that they've now collected, and also on several programs getting delayed and pushed out further towards the end of this year and into 2020. But they also clarified during the conference call that a lot of this is out of their control, as delays sometimes happen naturally, and their biggest partners are also being more strict and selective with the students that they admit, which obviously would hurt enrollment rates, and that translates to lower sales for 2U, since they usually take more than half of the cost of tuition in most cases. On top of that, most of their enrollment rates for their biggest programs have historically been much higher than they ever anticipated, so those large programs are now correcting back down, while the rest of their portfolio that is much newer is seeing tremendous growth. In fact, their top 15 DGPs are still expected to grow by 3% despite the huge declines in the top 5, while numbers 6 through 15 are expected to increase by a massive 32%. So just to kind of summarize that for you, that means that the top programs are correcting back down, while the lower ones are actually seeing sales surge higher to kind of help offset that. And the higher growth from those new program offerings is still pretty sustainable in my opinion, since they only have about 68 programs currently announced, but still expect to hit their long-term target of reaching 250. In fact, it wasn't too long ago that they gave guidance for 17 new DGPs in 2019, 21 in 2020, and another 25 in 2021, reaching over 100 by the end of that year. And they've already reached 68 of that, so they are well on track to hit and probably surpass those targets. And while their profits continue to struggle because of increased marketing, their revenue growth for 2019 is still expected to be 30% at the midpoint of that guidance, which is only about 3 percentage points lower than what Wall Street wanted to see. And it's still pretty much in line with their yearly growth targets of over 30% that they consistently hit. Here's a chart of all their quarters in the past 2 years, and you can see that they have a compound annual growth rate of over 37% going through all of those quarters. Even if we look back at their last 4 years, sales grew from $150 million in 2015 to over $400 million in 2018, with growth rates of over 37% in 2016, 39% in 2017, and 43% in 2018. Sure, that growth will drop to 30% in 2019, but who cares? As a long-term investor, I'm happy that this road bump is getting priced into the stock now, basically being baked, being scorched into the stock now, and leaving me with plenty of upside, especially if they end up beating that guidance, which, they often do. And speaking of the long term, there's plenty of future potential still left in the market. In fact, some estimates are pegging the online education market north of $300 billion by 2023 at a compound annual growth rate of 24% from 2017. And a new report from the National Center of Education Statistics showed that even though enrollments fell by 90,000 students in 2017, obviously this is in the US, the number of students taking online courses actually grew by 350,000 or 5.7%. So we'd actually be seeing much bigger drops in enrollment if it wasn't for the growth in online education. In fact, about 1 in 6 students is now taking courses 100% online, while about 1 in 3 students is taking at least one online course. So this is really an inevitable future that we're heading towards. Just like we saw Netflix disrupt traditional cable TV and Amazon disrupt brick and mortar retailers, I think online education is up next, along with electric vehicles like Tesla's disrupting the traditional ICE vehicle market. Now, there's no way to sugarcoat their valuation. There's a reason why the stock got destroyed today after reporting numbers that, in my opinion, weren't even that bad. But that's just the reality of most speculative growth stocks. You're going to have to pay a premium for that growth. Still, even with their price to sales ratio being as high as 6, it's really near the lowest levels that we've seen from them in history. You can't forget that just about a year ago, their PS ratio was sitting north of 15. So paying 6 times their sales at this level for a company that is growing revenue consistently over 30%, and 2019 is probably going to be their kind of worst year, and it's still going to be 30%. That and they still have a very bright future in a growing market. It doesn't really seem all that crazy to me to be paying this price. Now, they also have a phenomenal balance sheet with over $420 million in cash, $520 million in current assets, and $860 million in total assets, with only around $100 million in current liabilities and $167 million in total liabilities, giving them fantastic current and total ratios of both over 5 respectively. By the way, I mentioned in previous videos that this balance sheet can set them up for acquisitions to fuel future growth, and that's exactly what happened. In 2017, they acquired Get Smarter, which is a similar company, but they mostly offer short online courses and non-degree alternatives for the workforce, and they're based in South Africa and London, so most of their revenue actually comes from outside the US, giving to you even more international exposure. And just last month, they announced another acquisition, this time their biggest acquisition in history, for $750 million worth of cash and stock to acquire Trilogy Education. And they mostly specialize in skill-based technology courses, also known as tech boot camps, that teach a wide variety of extremely important skills, including coding and developer classes. By the way, taking coding and developer classes online is that's really where I think the future of those type of courses is headed. I mean, I know this is kind of anecdotal, but I have a lot of friends who actually take coding and developer classes online, so I'm just kind of really bullish on that fact. But anyway, this isn't even to mention the fact that this further extends 2U's international reach into Latin America and Europe, while also giving them access to partners in Australia and Canada for the first time in the company's history, many of which 2U can advertise their graduate programs to and lock in some very lucrative new deals, because some of those, they don't even have any kind of history of working with 2U, so these are potentially new clients for them. So in conclusion, there's not really much that I can add to this. I've pretty much said everything that I needed to say. I really think that the future of education is online, and it's just so much more convenient. If I had the choice to take online courses or have to drive all the way to campus and go into class, and maybe you only have one class that day, and you got to spend so much time just driving all the way to school. A lot of people commute like an hour or more to get to school, and then they got to drive all the way back. Many people go to school and have jobs. They don't really have time for that. So having an online course where you can do your homework at 1 in the morning, you can it's all just kind of set on your own schedule. That's just so much more convenient. So it makes complete sense to me that while traditional enrollments are actually going down, online enrollments are actually going up. So it's kind of an inverse relationship. So anyway, I think that that's the future of the whole kind of industry. And I think 2U is just a very big kind of pure play on that. So that's why I want to invest in it. But anyway, stock is down 25%. I couldn't help myself, had to open a position, and I'll probably add to it slowly. You guys know me, I like to add slowly as stocks go down. I'm much more comfortable buying stocks when they're going down rather than when they're going up. So that's kind of how I feel about it. But let me know what you guys think. Leave your comments down below if you have any questions, comments. Do you like this stock? Are there any growth stocks or spec stocks that you guys like? I'd love to hear your thoughts and recommendations down below. And I will catch you guys in the next one. Take care. Bye-bye.